Good evening, and welcome to the Perspecticast, the audio companion to the Panda Perspective Substack. Um, it's been a very pleasurable week for us here on account of our 11-year anniversary. We've been celebrating with the entire Panda family out here, and on account of that, the posting has been somewhat reduced last week, and it's been a fairly slow return to form this week as well. This obviously is all coinciding with a deep dive into the property sector that's actually a little bit more complex than appeared initially. We'll jump right into it, only to acknowledge that my new article came out in the China Daily. Link below, check it out. Happy with it. It's obviously about Hong Kong and how the reason why I don't really believe the ADR delisting narrative because it's a massive own goal by the US, precisely for the reasons outlined in the article. Do check it out. It's free to read, so by all means, please do. Out here on the blog, we're dealing with the properties, and my initial preconception was that it's going to be an easy story to tell, that one way or the other, there's been a bottoming, at least in some select areas, and it's an easy enough social and business dynamic to convey. These property companies have suffered, but we're coming out of a fairly meaningful correction. Where in fact it's a much more complicated dynamic, right? I mean, it's obvious that as a whole, the industry has bottomed, but it's still nevertheless a very large industry, right? I mean, sales are down, but they're not down crazy, right? There's still a lot of social programs. People still need houses, right? There's still transactions happening. And this is where the geographical differences really come into their own, where tier 3 and 4 cities are faring much worse than tiers 1 and 2. You kind of would probably expect that if asked, but this is quite an interesting contrast to the fact that tiers 1 and 2 are doing worse in personal consumption, but it's just something to bear in mind. It's also somewhat puzzling, or maybe not puzzling, but it's definitely not that the actual volume of starts and completions picked up quite significantly, but it's a nice sort of decelerating glide path if you look at the sort of early 20s data and compare it to now. And this is where our steel research does come in very handy because we've been guided for an 850 million ton annual output for some time. We're kind of sort of on the way there, right? A total output of about 950 to billion tons, of which about 100 million or thereabouts gets exported. These are obviously rough numbers. Exports were a bit higher last year, about 110. Going to be a little bit lower this year, closer to like 90 million. But if you take that as a rule of thumb, that they're trying to export about 100 million tons, then consume domestically about 850 to 900 million. That gives you the current capacity, and they'll continue subbing out blast furnaces, especially outdated ones that are still there. Eventually, they will all get rolled out and replaced with electric arc. But that's sort of a longer term story. When it comes to the properties still 42, 43% of total steel demand domestically, right? And they'll continue to do so. It's down from 51% at peak, right? But nevertheless, it's still a very significant part. Purely on secondary indicators, of which steel demand being number one, we see that the property industry is actually chugging along. Now, obviously, it's struggling, but it is chugging along. Now, secondly, the developers have started building up land bank again, especially the state-owned ones. And this is, I think, the most interesting development, where state-owned developers are clearly in much better shape than the private ones. And this is flipped, and again, in around 2021, right? And since then, the market share of state developers has increased, and also the general state of affairs is clearly better in the state-owned sector than it is in private ones. I mean, overall, the amount of debt in the system has been reduced quite dramatically from 200 to 150%. And quite frankly, maybe the most interesting part of it all is the fact that, don't tell anybody, but slowly but surely, rent support is coming into the China market. Rent support. something that's completely unheard of. I mean, for those living in the more developed property market, like London or New York, right, you anticipate rental income, right? The rental income is one of the drivers of purchasing decisions. And being a landlord is something that people aspire to. In China, rental support just wasn't a thing, right? Maybe you could get 80 bips a year, something like that. That's not entirely true. Rent was a thing very early on when a lot of foreigners came and a lot of people from sort of rural areas of China started trying to sort of make it in the bigger cities and that sort of thing, right? Obviously, there was just not enough housing to go by, but also it was a very different market environment. And back then, you could actually get a degree of yield, but it wasn't clear that wasn't proper market development. This is just very early supply-demand misalignment. Whereas now, finally, the prices have dropped, rents have sort of crept up a little bit, and now we're looking at a 2.5% rental yield. Now, of course, right out here in the UK, for example, you can get rental yields of 7, 8, 10%, depending on how far up north you're willing to go. So we're quite far from that, but 2.5% in Chinese tier one cities, not far off from what you get in London. That to me is again an interesting indicator that the market is probably um, finding its footing. Rental support is all we need. And the other thing is rental support is called that because it's near enough to the mortgage rates. And if you can cover your mortgage with rent and just keep it going for a long enough period of time to eventually own the property outright, I mean, obviously that's something people like doing. Again, good developments. Very much looking forward to seeing how that develops. But I'm not even looking at it from the point of view of strong price dynamic, but rather from the point of view of a market that's unclogged, right? A market that is clearing, a market where transactions happen. I think in tiers one and two cities, we are there or thereabouts. We're not far off. In fact, probably tier one, we're definitely there. Tier two, we're kind of on the verge. Now, what about tier three and four? Well, we're not there yet. I believe that the question of oversupply is more acute in tiers three and four, especially in the northern tiers three and four. Because as we mentioned before, there is obviously a very significant move down south, and China is the same as southward migration as in the US or in Russia or in the UK for that matter. So um, these bigger structural moves are intact. Nevertheless, it just shows that you can get those markets to clear. Now, the only thing is we now need to make sure that there is enough attractiveness behind those tier three and tier four cities, which is where I think government fixing them up or increasing their size, but buying projects in bulk and just rezoning, resizing them, and things like that for families and things like that would probably be the way they would have to go. And on these completely unsold projects, whilst absolute numbers are still quite large, they're not crazy large anymore. All of this will be presented in the property piece that's coming out tomorrow. That will include all of this that we've discussed here and so much more. So please do subscribe and read. If you subscribe today, you obviously get the note tomorrow. And I do recommend it because I think getting property right will be crucial and critical for performance this year. You didn't need to. Just being out of property has been a pretty solid bet. There's a lot of volatility, both directions of bad news, good news, few and far between, but there's always a relief rally here and there. It was a tricky industry to own up until recently, but I think it's time to figure it out and to have a definitive view, either a short or long. And please read the note tomorrow to figure it out. And thank you for listening to this. Thank you for being a subscriber if you are one. Yeah, let's dive into this in the piece tomorrow.